What's up, apes? Welcome back to the Daily Peels Daily Podcast of the day. My name is David. Thank you all so much for joining us here once again on this beautiful Tuesday, September 3rd, 2024, just a day after Labor Day, which we, of course, in the United States celebrate by making minimum wage employees continue to give us their labor. So it's truly a great holiday for the rest of us out there. So hope you had a nice long weekend. I'm very glad to be back with the Daily Peel Daily Podcast of the day because we've officially relocated. The Daily Peel Global Headquarters is no longer based in Charlotte, North Carolina. It is now based in the great state of Massachusetts. So shout out to my fellow Northeasterners, Bostonians out there as well. You guys are always the best, and I'm glad to be back up north. Okay, let's go ahead and start talking about what you guys actually care about within this video. So we got a lot to go over here today. I'm going to be getting into the intricate details of my own personal home buying experience, along with manufacturing report today that's somewhat worrying for the future of the U.S. economy. And of course, we'll be going over our thoughts on some of the biggest stock movers of the day. Let's go ahead and dive right in. So WSO Alpha portfolio down about 1.99% on the session today. Definitely a rough session out there. It was not ideal, but truly it wasn't ideal for anybody out there. I mean, mega caps, tech stocks led the sell-off. Usually, that means it's a pretty good thing for us over here at the WSO Alpha portfolio, considering that the NASDAQ index was down 3.26%, or about 3.3% on the day, with the S&P down 2.12%. All in all, pretty good day. We outperformed both of the indexes, so we can't really be too upset about that. NVIDIA did most of the heavy lifting heading downwards. We'll talk about that in just a quick second, but I think every single one of the Mag 7 stocks was down at least 3% today. Maybe Apple is down closer to 2.75% or so, but still very ugly day as people. It seemed like analysts kind of took the long weekend to reassess exactly what's going on in markets. They were considering NVIDIA's earnings guidance seemed to be kind of the primary factor, but overall, it seemed like a day of profit-taking heading into a period of uncertainty. Profit-taking is generally the reason that journalists subscribe to sell-offs when they just have no fucking idea what's going on. So I feel like I should add that part in too. That very well may not be the case, but as far as what I can tell right now, it seems to just be nerves coming in, basically saying, we don't have a clear view on what's going to be maximally beneficial in the, when the Fed starts cutting rates and as the economic environment starts to change. So let's go ahead and start selling off some of our big winners, collect some of those gains, and, build up a little bit of a cash pile so that we can take advantage of any new opportunities that might come our way as rates fall, as the economy slows, and whatever else it might be. All right, let's go ahead and move into some of the banana bits. So first and foremost, this came out after the bell here today. So this didn't even have anything to do with NVIDIA's horrific collapse, but the DOJ is getting all up in NVIDIA's business. They have officially sent the big tech company a subpoena related to their ongoing antitrust investigation. Basically, a lot of analysts are saying that the DOJ says that NVIDIA makes it harder when they don't exclusively use NVIDIA products, both hardware and software. So it kind of locks buyers into some kind of antitrust dynamic version of, buying NVIDIA's products, I guess. So I haven't read the investigation too in-depthly, but that is definitely going to be something that we're talking about in tomorrow's Daily Peel. So I will have a more thorough update for you tomorrow. Make sure to check back then. Meanwhile, JP Morgan's chief strategist, Dr. David Kelly, this guy's great. Whenever he goes on podcasts, always does a great job. He released this fucking book talking about demographics, debt, and, quote, apocalyptic assets and their relevance to the United States and specifically the US dollar. Very long piece, very intricate, and honestly quite entertaining at the same time because he was talking about the big macro level things that we love to ponder on here at the Daily Peel Global Headquarters. Meanwhile, at the same time, speaking of certified smarty pants like David Kelly, our other favorite certified smarty pants, Mr. Torsten Slok, estimated he kind of ran this model at Apollo, kind of like a light version of the Fed's own economic model, but basically saying that if the Fed decreases interest rates as they're currently planning on, and by that I mean by about 100 basis points by the end of the year and then another 150 basis points or so by the end of next year, he estimates this will add an increase of about 2.2% to GDP, but also increase inflation by about 1% or so. Another very interesting piece on exactly how that all works. Meanwhile, CrowdStrike just got called to the principal's office. If you ask me, it's about time because that outage a couple weeks ago was truly an absolute abomination. I mean, to fuck over, thank God I was not traveling on that day because I think there may have been another 9/11 if I was, because holy shit, that would have been the most frustrating thing in the entire world to not be able to get on a plane because the fucking cybersecurity system for the airline is down. Like, Absolutely ridiculous, but they are getting called in front of Congress later on this month. So once again, we'll see them under fire at the principal's office. Finally, blue sky users are absolutely surging in Brazil as the entire country is fighting Elon Musk and the X, formerly known as Twitter platform. So we'll see what goes on with that. It is currently banned in Brazil, but that probably, we'll see how long that lasts because Elon is pretty upset about it. So it's basically Elon Musk versus the entire country of Brazil. Place your bets now. We'll see who wins. Okay, moving on into our big story, our macro monkey of the day. This is something I've been promising you guys for quite some time here now because buying a home in 2024 is kind of like buying whole life insurance. It's just one of those decisions that you probably shouldn't make unless the circumstances are heavily pointing in that favor. And well, that was the case for us. So what I want to do here today is talk about the high level, very high level details about the home buying process in 2024. If it's something that you guys like and respond to, then, we can certainly get more granular as we go along with it. So basically, the idea with buying a house in 2024, they say that the purpose is to buy low and sell high. I don't know about you apes, I've never been one who wants to take the easy path, so I figured let's make this a challenge and buy at the absolute highest price point that we possibly could since the global financial crisis, buy during the worst market that we possibly could. And that is exactly what we did. There's almost half of you indicated that you're going to be purchasing a home within the next 5 years or so, and more than 75% of you said that you're going to be doing so within the next 10 years. So all the more relevance to be kind of discussing this stuff and going a little bit further into detail. Hopefully, you don't have to buy in such terrible timing as I did, but because I did, I figured might as well go ahead and expose myself already. So what happened? Well, the housing market has gotten completely through the roof since 2020. The pandemic, there are a few bigger beneficiaries out there than the housing market from the pandemic era. So home prices since 2020 have increased by about 46.24% according to the Redfin Home Price Index. This is our preferred index because it does it on a more timely basis and it gets it directly from the MLS instead of resale data like the S&P Case-Shiller does. So it's a little bit more effective, a little bit more holistic, and most importantly, it's more predictive of where things could be going given certain situations that have happened in the past. But home prices increased 46.24% about on average in the 5 years from July 2019 to July 2024. That is an annualized rate of about 7.9%. Now, at the same time, the house that I purchased, this is in the Massachusetts area, that's about as far as I'll go on that, increased 47.26% from the last time it was sold, which was in 2022. So that's an annualized rate of 21.35% based on the price that my dumbass purchased it at. So this is all to say that when you are looking at, when you're kind of assessing the housing market and deciding like, is now the right time to buy? What do we want to get? How much do we want to spend? Fuck national indicators. They are absolutely worthless in an individual's home price search because national indicators are going to be the entire nation. And this is the most regional market that there is. So, Massachusetts, Northeast Massachusetts has been one of the kind of leading areas in terms of home price appreciation across the country, is bringing up that national average. And that was something that we were aware of and looking at the, going through our home price search. We're like, okay, these are going to be the most expensive houses in the country. We are going to have to go with a fixer-upper. We're going to have to go with a bit of a lower price, which ended up working out for us because another one of my big pieces of advice in purchasing a home is leverage your personal network. Like I said, we went with the fixer-upper because the area that we're purchasing in saw prices increase by much more than the national average. However, lucky thing is both my and my girlfriend's dads work in carpentry. So a little bit of labor arbitrage there with a lot of the work that they can come in and do. So make sure to leverage your personal network. You have things that will work to your advantage when you're buying a home. Make sure to go ahead and follow those. But at the same time, it's not just about the location that's going to kind of be the ultimate judge of where prices are going to move going forward. There's a whole lot of things to consider as well. School districts, population trends, property taxes, HOA, local regulations, access to highways, all this stuff is going to deeply influence the price of a house. And it's things that we don't even think about for the most part. The neighbor's dog, if he barks a lot, that's going to hurt the home value. Now, this is kind of more external to the house, but on the internal side of things, there are a lot of things to consider as well. And so my basic idea is that you want to focus on the unchangeables within the house. So that was kind of our big focus in the unchangeables, meaning location, yard, foundation, structure of the house, all that different kind of stuff is going to be most important. And it's things that you absolutely cannot change. So, like some of these things you got to be a little bit flexible on, but things like, for us having a yard, for example, for our dog, or having a a house that was built after 1978 because of the risk for, lead paint for like any kids that come in the future, or asbestos or something like that. So it's just, don't pay attention to these national indicators. It does not matter at all for you in your home search. And the second thing I want to talk about is interest rates here. So the day that I actually closed on my house was August 16th of 2024. But at that time, we basically had our financing finalized, and really all that we had to do was put our down payment down on that day, then go sit in the lawyer's office for like an hour while he roasted my mustache, and I roasted him for being bald. It was a grand old time, to be quite honest with you. He was the most exciting attorney that I could possibly imagine. But still, interest rates are a big part of the conversation as well. We bought our house with an interest rate of 7.125%. Absolutely horrific, eye gouging, makes me want to fucking, I don't even know. It makes me want to jump off the roof of the house that we just purchased here, because 7.125, ridiculously expensive. Even if we, everybody says that you can just refinance, but refinancing, it's a bit more of a complicated process than it sounds like. So first and foremost, comes with its own set of closing costs. That's not exactly something that you want to get into after you just paid your own original closing costs. Plus, doesn't even matter for us because our lender has a 6-month seasoning period. So we can't refinance for at least a 6-month period. Quite honestly, that's a good thing for us. We're not going to do it anyway, but even still, the fact that we are not necessarily not able to, but like we wouldn't do so anyway. So it doesn't really create much of an issue for us. Maybe that's something worth paying attention to for some of you going out there and purchasing homes within the next couple of years. But for us, wasn't a major problem. We have decent credit scores. We're both 24 years old. It's, 7.125%. It was above the national average, but not a ridiculous amount above. That brings me to my next point. So the week that we bought our house, the prevailing national average home prices was about 6.49%. So about 6.5%, meaning that we would have got about 60 basis points or so on top of the prevailing national average. But what actually happens is typically you're going to be working with your lender and kind of not necessarily finalizing, but on paper finalizing the lending terms weeks before you actually close on the house. For us, it was 3 weeks before. So at that time, prevailing interest rates were sitting at about 6.89%. So they had fallen 40 basis points in the 3 weeks from them. We probably could have gotten our interest rate to, in the 6.75% range if we did this on a 3-week delay. But still, it's just kind of luck of the draw at that point, because what am I going to sit here and be like, okay, the market is going to start to realize that 𝗟𝗡𝗚𝗛 wants to cut rates by August 8th, so we can't purchase the house or we can't finalize our financing until after August 8th. Like, no, that's just getting too ridiculous with it. You're not going to optimize it on your first time home purchase. A couple other pieces of advice I have: do not buy a house for cosmetics. You can paint, you can redecorate, maybe even have some labor arbitrage like I have. Like I said, leverage a personal network, focus on the unchangeable, start early. Very similar to college. It's never too early to start looking. You can kind of familiarize yourself with the market. You can see, how often new listings emerge. Plus, when you're kind of looking around at things, certain things start to emerge that you don't really realize that you would actually prioritize. Like, I thought I wouldn't really care about having a garage or like a finished basement or anything like that. Turns out I do care quite a lot about having a garage. And so thankfully we do have one. Then finally, my last piece of advice: don't use friends in this process. I know it's one of those things that it seems like, okay, I trust this person, I should go with them and have them guide me through it. We got lucky. Our realtor was my girlfriend's friend. She did a fantastic job. But the realtors that you work with have lenders that they're going to go through. And during the process, you might find out that your friend that's a realtor or the lender that they use is actually a fucking moron in disguise. And unfortunately, that is something that we learned along the way. So we definitely do not want to, our realtor was great, but the lender person that you went through was definitely not ideal. So just be careful when you're selecting the people that you want to work with. Make sure that they're not fucking morons before you go into it. And plus, if you don't use a friend, you don't feel bad when you say, hey, this isn't working out for us, we're going to go to somebody else. That's definitely an option that you always want to have. So in total, some statistics for you guys about my home price search. We had 112 saved homes on Zillow. We toured 37 of them, made 15 offers, got 2 offers accepted, and purchased 1 home. Our average offer price was 11.5% above asking, and the ultimate purchase that we went through was 7.5% above asking. We actually got very lucky on that asking price as well. So once again, if you guys like this stuff, if you want me to talk about it more organized and kind of more in detail, I'm happy to as well. Just kind of throw in a bunch of ideas against the wall for now and see what sticks. Let's go ahead and move into what's ripe / what's rotten, some of our big stock moves of the day. First and foremost, we have Vite, a company that I had never heard of before 2 p.m. today when I started looking at what was moving, but effectively, this is a vaccine company. And now, as of today, they're closing above $12 billion in market cap. So seems like something we should probably pay attention to. You know it's good. It's a bad day in markets when I have to resort to biotech stocks to fill up what's ripe or what's rotten, because holy fuck, I have no clue what this company does. They do make vaccines, and that was the big news of the day yesterday. 𝗟𝗓𝗚 Partners called recent study results from Vite, quote unquote, stunning. These results are allegedly stunning because they are basically what Vite is developing is a pneumococcal vaccine, a vaccine that can fight against all the different strains of pneumococcal disease, apparently. I mean, I don't really know what it is, but this vaccine is allegedly going to fight it. And so the big reason, or the big news that everybody was so stunned by here today, was because Vite's vaccine protected against 31 strains of pneumococcal disease, whereas prevailing market dominant pneumococcal medications only block about 20 strains or so. Specifically, Prevnar 20 from Pfizer only blocks about 20 strains. So analysts at 𝗟𝗚 Partners said that it was stunning because this new young biotech is attacking all 31, whereas Pfizer can only get up to 20. Obviously, that puts Pfizer's margin at risk. Okay, moving on down below to a company that I've actually heard of before. We have Unity Software. This stock actually, it opened up the day much higher than it closed, and then actually traded lower for most of the session. Opened up about 9.8% and then traded down 2.02% was its final finish for the session. Basically, Morgan Stanley came out there and threw him the alley-oop. They said, quote, "They are more confident than ever," which ironically is exactly what my first boss said to me as soon as he fired me from the pizza shop that I used to work at. More confident than ever in the team, and Morgan Stanley is more confident than ever in Unity Software because allegedly recent internal data is making it clear that Unity Software is, quote, "the clear game engine." That is the exact terminology that Morgan Stanley used, which apparently means that they think Unity will maintain and grow its position as a popular system for developers to build their games on. Specifically, Unity kind of dominates in the mobile space, the AR/VR space, and then they have a big presence in the PC space as well, but potentially not as dominant as in these other sectors. So the stock was up big on that good news. Moving on down below, we have United States Steel Corp. This is the stock ultimately ended up finishing the day down about 6.09%, or about 6.1% in total. Basically, the big thing was comments from Vice President / Democrat nominee Kamala Harris over the long weekend, at I don't want to say rally because I think that's exclusive for Trump, but at a speech on Monday, on Labor Day, when she was in Pittsburgh appealing, or I should say patronizing unions with her presence. Basically, whatever. Pretend I didn't say that. But she was at a speech for some unions in the Pittsburgh area and basically made it clear that she wants to keep American steel American. Nobody is stealing our steel under Kamala Harris's watch, and the market is honestly pissed about it. Like I said, stock down about 6.1%. That's because Harris, the implications from her comments are that she would oppose the agreed upon sale of U.S. steel to be sold to Japanese buyer Nippon Steel. So this is basically the market saying, we don't like that Kamala would come in and stop this deal from occurring. Kamala is basically saying, I don't want to export, some of our most important natural resources to Japan, even though it's a friendly country, still would want to keep that stuff domestic, whatever. Okay, moving on into our last big stock mover of the day. We have NVIDIA down a big 9.53%. I'm going to have to reorder those for tomorrow's piece. Nonetheless, absolutely horrific day. It was even worse today than it was in reaction to their earnings report. And it's basically just because analysts kind of took the long weekend to think about things and say, well, they're kind of fucked because one of the biggest reasons that NVIDIA sold off following their earnings report was because of weak guidance. Now, when I say weak guidance for NVIDIA, it's not weak guidance. It's just weak for NVIDIA. They're not projecting, quadrupling revenue within the next week like they have been in the past. So basically, one of the big focuses for analysts was that management indicated supply chain difficulties related to the Blackwell chip. This is the new line of chips that NVIDIA is going to be selling going forward. And allegedly, there are some production delays that's going to, make it take a little bit longer for these to come into, to actually hit revenue and, to actually start to see growth from that Blackwell unit. So the market's basically saying, well, first of all, the growth that was reported for the latest quarter wasn't as stellar as we thought. Plus, they're having production delays with their new hot product, which means revenue and earnings are going to be a little bit slower going forward. So not only is that bad on the fundamental side of things, but that means their valuation is going to get trimmed. So once again, this is a combination of a valuation-based sell-off as well as a fundamental triggered sell-off. That's why you see it down 9.53% for the day. Plus, probably a lot of profit taking at the same time, kind of like we mentioned beforehand, and that may have bled into the rest of the big tech market, selling off for the session. Based on tomorrow and the rest of the week's results, we'll know if this is something actually worth worrying about. But for now, who cares? Fuck it. It's just one day. Okay, well, let's go ahead and move on down into our final story of the day. We are, of course, talking about pregnant manufacturing. I know that might sound a little bit weird, but it absolutely is the case with all these contractions. So the U.S. manufacturing sector has been in contraction for 21 of the last 22 months. The only month that it wasn't was this past May. So for 4 months in a row now, we have also been in contraction. You'd think a fucking baby was on the way, especially with employment numbers going on in the manufacturing sector right now. It seems like there's certainly a lot of people going into labor within that sector. So you might think that things are going pretty well, but absolutely not. That is not the case whatsoever. In July, the ISM manufacturing PMI, in August, the ISM manufacturing PMI report, this seeks to measure total activity in the manufacturing sector in the United States, clocked in at about 47.2%. Now, that is in contraction territory. Anything below 50 is a contraction for the manufacturing sector. But that is an improvement from the 46.8% that we registered in July. So roughly a 0.4% improvement. Definitely something that we're looking forward to. Overall, it's not terrible for the economy because generally, it would have to be what the ISM says is when the index comes in below 42.5%, then that's generally an indicator that the entire economy is in a recession. Because we're above 42.5 but below 50, that we can say manufacturing is in contraction, but not necessarily in a recession. Now, some of the biggest detractors for the last month, or the biggest detractor, was new orders. So new orders, this is where companies are kind of sending their demand. It's basically the best measure for business-to-business demand within the manufacturing sector. It kind of says how much cash, how confident are these businesses that the products that they order are going to be sold within a reasonable time frame. If they are increasing new orders quite a bit, that means that they are more confident that they'll be able to move more product off their shelves within a shorter or the same amount of time. But if this is decreasing, that means a couple of different things. Demand is lower. Maybe they don't need as many things. Maybe certain estimates of demand were off for them. Nonetheless, new orders were the primary detractors, falling about 2.8% for the month of August. But at the same time, some other dynamics were going on that might not make this as worrying as it seems. So at the exact same time, inventory levels continue to rise. So total inventory was up 5.8% for the month, and the backlog of orders was up 1.9%. Prices were also up 1.1% in total. So if we look at inventories up 5.8% and the backlog of orders up 1.9% versus new orders down 2.8%, what does that tell us? Well, the issue might be more in inventory management and a delivery side of things. So if these companies, maybe they had ordered too much in the past couple of months, now they don't necessarily need all those new orders because they have to move this inventory off their shelves. That could potentially be an inventory management issue, especially when we go ahead and take a look that supplier deliveries were also down about 2.1% decline for the month of August. So we're seeing a decline in supplier deliveries. We are seeing an increase in the backlog of orders. We're also seeing a decline in new orders. So this could mean a whole lot of different things. There's a lot of different possibilities and probabilities that could imply for the U.S. economy. But because these other things are down, simply the fact that new orders is down doesn't necessarily mean that demand is falling across the board. Now, the concerning thing is that we have been below the expansion line for well over a year at this point, if you exclude May of 2024, which was arguably a blip. We've been in decline for quite some time here now. Manufacturing tends to be a leading indicator for the U.S. economy. We can see this if we look at the data. We started ripping. We were above 60% U.S. manufacturing PMI by summer of 2020, very much foretelling the absolute renaissance of manufacturing and demand that the U.S. economy was about to experience. Then now we've been in contraction territory for, like I said, 21 out of the last 22 months. If that is telling us anything, probably not going to be looking pretty on the demand side of things going forward. But again, not making any predictions here, just saying that is kind of what the data would indicate at this point. All right. This edition was way too long here today. So guys, let us know what you liked, what you didn't like about the new setup, about the new video formatting. We want to make sure that this is something that you guys are enjoying, you find value in on your ride to work, when you're, wake up in the morning. Maybe you're listening to me when you're in the shower, which is pretty cool if you ask me. But nonetheless, I'll go ahead and end it right there. Give us some notes, give us a like, subscribe, comment, all that stuff. Let us know what you like, what you don't like. We want to get better for you guys day in and day out. So definitely don't be shy. Reach out to us. My email is just david@wallstreetoasis.com. Shoot me a message. Let me know, where we can improve, what we can improve upon, and any other further detail that you want. Personally, emails get personal responses. So thank you guys once again. Happy investing, happy trading, and bye now.